In the 13th century, Europe underwent a major transformation. Trade and commerce flourished locally, regionally, and internationally. This period saw rapid technological advancements, including the adoption or invention of windmills, watermills, printing, and this was the Middle Age. And in other words, this also marked the dawn of the Age of Discovery. This period also coincided with the rise of the stock market. In the 18th century, the first ever stock exchange originated within India when the East India Company started offering shares and bonds in exchange for capital. In the 19th century, the Bombay Stock Exchange became the first ever professionally traded stock exchange in the whole of India. And this was what led to the rise of the stock market. And as of today, as of 2024 May, the Bombay Stock Exchange has a market capitalization of 5.2 trillion US dollars. And the market cap has jumped by around $633 billion in 2024 itself. While there's a percentage of the population that is very optimistic about the equity markets, there's a percentage of another part of the population that is not as optimistic about the equity markets. Some say it's a gamble, some say it is too risky, some would rather stay away from it completely altogether. And here's why we feel equity investing makes sense for everyone. Let's imagine two individuals, Ashwin and Ramesh. Both of them are 18 years old and both of them have just received their pocket money of rupees 1,500 from their parents. While Ashwin is a very aggressive investor that goes and deploys money into mutual funds for a time horizon of 3 years to buy a mobile phone, Ramesh, who has a very similar goal of buying a mobile phone, does not know where to invest and is very afraid of investing money in the markets, so he keeps the money in the savings account itself. While mutual funds at the end of 3 years deliver 10% returns per annum, savings account only delivers 2.5% per annum. And ultimately, Ashwin ends up with around 63,195 rupees, while Ramesh only ends up with 56,133. While Ashwin buys a better phone, Ramesh ends up buying something a little less in terms of quality. Fast forward to a few more years later, Ashwin and Ramesh both become 21 years of age. While they both have a higher capacity now, because both of them are working as interns in an organization, each of them can invest 5,000 rupees each at the moment with a time horizon of 3 years, and this time they want to buy a laptop. While Ashwin invests money in mutual funds, Ramesh invests the money into a recurring deposit offered by a bank. With a time horizon of 3 years, they kickstart, and at the end of the 3-year period, Ashwin ends up with around 2,18,825 rupees, while Ramesh ends up at 2,07,799 rupees. And this is while assuming an increment of 5% in their investment every year. Now, Ashwin ends up with a better laptop, while Ramesh buys something a little bit less in terms of quality once again. At the age of 24, the both of them start earning 50,000 rupees per month in salary. And while they are in a position to invest around 30,000 rupees a month, what they do is Ashwin invests 15,000 rupees a month in mutual funds for his wedding, while Ramesh invests the same 15,000 rupees per month in gold for his wedding. And with the balance 15,000 rupees each that they have, they've invested money for long-term wealth creation. That is to retire at the age of 55. 6 years down the line, at the age of 30, Ashwin ends up collecting 17.5 lakhs at the rate of 12% in mutual funds, while Ramesh ends up only collecting as much as 15.47 lakhs at the rate of 8% while investing in gold. And once again, Ashwin ends up having a better wedding. And fast forward to years later, Ashwin continues investing in mutual funds, but this time, as the wedding goal has already been achieved, he's in a position to invest 30,000 rupees per month more. And the same can be said for Ramesh as well, who can invest another 15,000 as his wedding goal has also been met. The both of them continue investing for another 15 years till the age of 45 with 30,000 rupees per month and a 5% increment every year. And at the end of the 45 years of age, Ashwin ends up having 2.53 crores, while Ramesh only has 1.38 crores. Ashwin generated a return of 15% per annum, while Ramesh only generated around 8% per annum while investing in gold. Fast forward to the same 45 years of age, Ramesh finally realizes that it's time for him to start investing in equity. And even before he knew it, he was already too late. Because at the age of 55, Ashwin ended up having 3.89 crores, while Ramesh as he started a bit late, only ended up accumulating as much as 2.7 crores. Now here's a chart showing the historical performance of different asset classes, because if you look at it very closely, today 1 lakh invested in a fixed deposit over a 5-year period as on 31st of December 2023 is worth around 1.43 lakhs at the rate of around 7.25%, whereas on the other hand, over a 10-year period, FDs are delivered around 9.25%. But on the other hand, if you look at the performance of gold over a 10-year period, money has doubled. And at the same time, over a 5-year period, gold has doubled. But what does this mean? This means that between 2014 and 2019, gold didn't perform anywhere nearly as much. Most of the performance was seen in the last 5 years due to the uncertainty in the market. And if you look at the performance over the last 10 years in PPF, the returns have been in the range of 8.7% over a 10-year period and 8% over a 5-year period. But in comparison, if you look at the performance of various mutual funds during the course of this period, say for example, a multi-asset fund has delivered anywhere around 15.98% per annum over a 10-year period, wherein your money has gone up 4x. Over a 5-year period, your money has doubled at the rate of around 18.26%. And there are other aggressive investments. Say for example, a small cap 1 lakh has become over 11 lakhs during this period at the rate of 27% per annum, while over a 5-year period, money has still gone up significantly during this period. So what does this mean? As of July 2023, an average Indian household has had a portfolio that consists of say property, gold, bank deposits, insurance, provident funds, equities and cash. But out of all of this, properties have had a huge allocation to the extent of around 50.7%, while gold has had around 15.5%, bank deposits have had 14%, insurance has had 5.9%, equities have only had 4.7%, while provident fund has had 5.8% and cash has had around 3.4%. And the bottom line is today, the real estate exposure in an average Indian's portfolio is around 50.7%. But this does not mean that everyone must invest their money in equities. It means that everyone should be investing in equities. I'm not trying to tell that equities are the end all and be all. But what I'm trying to tell is that equities should play a huge role in your overall portfolio, because that is the return generator in anyone's portfolio at this point of time. But that does not mean that you must have 100% equity exposure. That totally depends on your age. It depends on your goals, because generally an individual must divide his goals into immediate term, medium to long term and long term goals, and accordingly decide what percentage of money should be there in equity, what percentage of money should be there in FDs, gold, bonds and etc. And that's why there's a need to consult an appropriate advisor, and there's also a need to do your own due diligence on top of that. So thank you very much for listening in today. We're looking forward to having you over to listen to our podcast in the upcoming week. This is the Finhancers Midweek Digest. Do visit our website and download our mobile application on iOS and Play Store. We'll see you soon.